Hey, it's Eric Osnes with Homebridge Financial Home Mortgage with my weekly update on mortgage rates and the economy for the week ending June 17th. Here we are in summer and it's freezing cold here in the Northwest. This week was dominated by the Federal Reserve's Open Market Committee meeting, which concluded Wednesday with a 3/4% rate hike. That's the largest hike by the Fed since 1994. The Fed is finally getting serious about fighting inflation. Remember, it was only 3 months ago the Fed was still printing money, pumping money back into the economy, and just starting to back down from their misguided statements that inflation was transitory. Fed Chairman Jerome Powell's comments on Wednesday warned us to expect additional hikes in July of another half to 3/4%. These rate increases are designed to slow the economy, vanquishing inflation. But it will be almost impossible to do that without causing a recession. In fact, Fed officials are predicting that the unemployment rate will start to increase to 3.7% this year and rise above 4% by 2024. Those would be the highest levels since 2008. In the past, when the unemployment rate has been low, bottomed out, and then started to rise again, we have gone into a recession 100% of the time. What does that mean for mortgage rates? Rates follow the economy. So if we do head into recession, rates are going to go down. We expect that, and many economists I follow expect that to start to happen as early as the end of this year. So we could see rates lower, going into the new year. If you're looking to purchase a home this year, kind of with that in mind, a good strategy would be to structure your loan to keep your costs as low as possible. That might mean a slightly higher interest rate because there's almost certainly going to be opportunities to refinance to a lower rate in the very, very near future. And if you already own a home, but if you've accumulated debt over the pandemic, it's a really good idea to consolidate those debts into one lower monthly payment by refinancing. Even if rates are higher than where you're currently at right now, they're probably not higher than what you're paying on credit cards or other debts. And consolidating everything into one payment and one significantly lower payment is going to make you much more financially stable and able to ride out, any economic slowdown that comes with a lot less stress. For the week, rates are higher. Here's the national averages: 30-year fixed rate mortgage 6.05%, up into the 6% range. That's up 0.5% from a week ago. 15-year fixed rates 5.38%. 30-year fixed rate VA and FHA 5.58%. Jumbo 30-year fixed rates 5.07, first time they've been up over 5%. And 5-year ARMs 5.33%. So we're definitely seeing rates coming up a little bit, but cross your fingers here. Hopefully we're getting pretty close to an inflection point where we might see those start to taper down as the economic slowdown materializes. All that said, you're looking to buy now. A lot of folks are disappointed with what they're qualifying for with these higher rates. It wasn't what it was a few months ago. And, it makes it harder to find that perfect forever home. We all want our forever home, in the perfect neighborhood. But that may not be a factor. That may not be possible right now. So a two-step approach might be our only choice. I don't know about you, but myself, all my friends, we all started with starter homes. They weren't necessarily pretty. They weren't in the perfect neighborhood, but they got us into the market and they got us generating wealth. That gave us shelter and a stable monthly payment, better than rent. My first rate was 15%. And but even that was better than what it would have cost to pay rent. Over the years, we fixed them up. We made equity. We sold them, and we used that money to leverage us into a better home. Nobody wants to compromise on housing, but it's better to get into something now, even if it's not your forever home. So that could mean looking at neighborhoods that are further out, a longer commute, or searching for a townhome or a condo. If you're thinking about a condo, keep in mind a few things because the financing can be a little bit different for condo projects. Number one is we do have to take the homeowners association dues, the HOA dues, into consideration when we're qualifying you. HOA dues can be expensive. It varies from condo to condo. But they do cover things like insurance, maintenance, long-term capital improvements of the project, and so it garbage, water, sewer, sort of forced budgeting and savings to cover those types of things. Number two, the condo project has to be approved by your lender. We do have approval processes. They vary depending on the loan amount or the loan program and the amount of your down payment. So be sure and check with us on that. We review the condo budget. We check for reserves. We look for pending assessments, pending litigation, anything that could be a potential future financial shock, to make sure that those are all taken into consideration. Number three, you want to buy a condo where the owner occupancy level is at least 50%, meaning no more than half of the units are rented out. That tends to lead to a much more stable project and typically a more positive ownership experience. And number four, there can be restrictions on the use of your condo. So if one of the plans is to buy one and then maybe convert it to a rental later, purchase your next home, be sure to check the rules and the bylaws, because some condo projects have rental caps, limits on the number of units that can be rented. That's a good thing. But they also may restrict short-term rentals like Vrbo or Airbnb. So if that's part of your plan, just make sure you check on that before you jump in and buy. Many of my clients have started their homeownership journeys with a condo. It didn't take long to build equity and leverage that purchase into the next home. I'm always here to answer questions like this and work on strategies. You can reach me anytime. Call me 206-915-ERIC. You can email me, eric@ericismybanker.com. Check out our weekly radio show on AM 1590 every Saturday at 2 and Sundays at 3. And hope you have a great week. Keep our fingers crossed on the rates. I'll talk to you next week.